McDonald's, the global fast food giant, has been experiencing a mass exodus of its franchise operators, marking a significant turn in the narrative of one of the world's most recognizable brands. For years, these operators have borne the brunt of McDonald's aggressive corporate strategies, ostensibly designed to grow the brand. Yet, the more deeply the franchisees get involved, the more apparent it becomes that the benefits of this relationship heavily favor McDonald's, not them. For many, the dream of owning a successful restaurant franchise is tantalizing. However, the reality is often far from idyllic. McDonald's franchise owners on average earn about $150,000 per year from each restaurant, which, while seemingly lucrative, is significantly less. So when one considers the investment needed to acquire a location, anywhere from $1 to $2.2 million, essentially, these entrepreneurs are shouldering the hefty responsibility of operating a restaurant for a mere 10% return on their investment. Moreover, the benefits of franchising are skewed towards McDonald's Corporation. The franchisees, who invest significant resources in running the restaurants, are not even building their own brand. They are enhancing McDonald's brand image, which continues to thrive despite economic uncertainties. Regardless of recessions, layoffs, bank failures, or fluctuating interest rates, McDonald's stock remains at near record highs, and their profit margins are substantial. McDonald's astounding net worth of just under $200 billion, and its profit of over $6 billion in the last fiscal year, are stark indicators of the skewed benefits between the franchisor and the franchisees. The chasm between McDonald's corporate profitability and the challenges facing its operators has not gone unnoticed, prompting many to reassess the value of their investment and relationship with McDonald's. As a result, the rate of franchise turnover has skyrocketed. In 2021, a record 13% of McDonald's franchise locations changed hands, compared to only 6% of Burger King franchise locations during the same period. Even more troubling for McDonald's is the statistic that, between 2019 and 2022, 28% of their locations were either closed or sold off. Many operators assert that the situation is deteriorating, suggesting a growing disillusionment among franchisees with McDonald's corporate practices. One major bone of contention has been the remodeling requirement imposed by McDonald's in 2018, which was the company's largest renovation initiative in decades. McDonald's demanded new furniture, decor, counters, exterior redesigns, digital kiosks, and revamped drive-through lanes for its outlets. These improvements, while enhancing the customer experience, were a significant financial burden for the franchisees. McDonald's covered only 55% of the renovation expenses for its 14,000 US restaurants, leaving the franchisees with an average cost of $350,000 per restaurant. Older, more outdated stores faced even higher renovation costs, further straining the operators' already tight budgets. Not surprisingly, this led to a massive backlash from franchise owners, who felt betrayed and burdened by the corporation's top-down remodeling directive. This feeling of discontent among the operators was confirmed by the National Owners Association, a union formed by the franchisees in 2018. The association has been attempting to advocate for operators' rights and interests, but it seems their efforts have had minimal impact on the corporate policies. McDonald's not only dismissed their concerns, but also attempted to offload more of the remodeling expenses onto the operators. This further increased the tensions and solidified the notion that McDonald's prioritizes the interests of end consumers and shareholders over those of their operators. Another sobering reality for many operators is the realization that, despite appearances, they are not McDonald's true partners. While consumers may associate McDonald's with burgers, fries, and the iconic golden arches, the real end consumer of McDonald's is actually the operators. McDonald's former CFO famously stated, "We are not technically in the food business. We are in the real estate business." This reflects the hard truth that McDonald's profit primarily comes from leasing their real estate to operators. The stark reality of the operators' predicament was brought into focus during the recent pandemic, when McDonald's assets soared due to the real estate boom, while many operators struggled to meet their obligations. This prompted many operators to view their relationship with McDonald's in a new light and prompted a drive to exit the franchise. Unfortunately, even the process of leaving the franchise has proven challenging for many. McDonald's has shown an apparent disinterest in the reasons behind the operators' departures, and they've even restricted operators' ability to select the successors for their locations. This further fuels the belief that McDonald's is more interested in attracting passive investors rather than supporting dedicated, hands-on operators. As the disillusionment among operators continues to grow, the future of McDonald's may be at risk. While the corporation has managed to shield itself from immediate impacts, the steady exodus of franchisees will inevitably affect the quality of McDonald's franchise fiasco. In the ever-changing dynamics of global corporate structures, McDonald's franchisees have had their fill of the corporation's heavy-handedness. For decades, the dream of owning a thriving restaurant saw them endure the stringent franchisee policies and aggressive corporate maneuverings of McDonald's. However, the promise of the Golden Arches appears to have lost its luster. On average, a franchisee earns $150,000 annually per outlet, which may seem lucrative initially. However, the investment ranges from $1 to $2.2 million for each location. The subsequent return on investment, ROI, hovers around 10%, equating the income to running a full-fledged restaurant business. Given these metrics, some argue it might be more financially sound to invest in S&P 500 stocks, which offer comparable returns without the operational hassles. Further, while franchisees invest their efforts and money into enhancing the McDonald's brand, they are not establishing their independent business identity. The corporation's thriving valuation, reaching almost $200 billion and boasting near all-time high stock levels, reflects this. The company has also reported substantial profits, earning over $6 billion in the past year alone. In contrast, franchisees are beginning to question the worth of their investment. The year 2021 witnessed a record 13% turnover of franchise-owned locations, a figure twice as high as Burger King. Furthermore, between 2019 and 2022, McDonald's saw an unprecedented 28% of its locations being sold off or shut down. Reports suggest an increasing trend among franchisees eager to exit the brand. McDonald's Remodels initiative in 2018 marked a turning point in this exodus, heralding one of the most extensive renovations in decades. McDonald's franchisees were required to overhaul their locations with new furniture, decor, digital kiosks, and drive-through lanes, among other changes. These changes weren't merely cosmetic but a significant financial strain on franchisees. The remodels affected approximately 14,000 U.S. restaurants, with McDonald's covering 55% of the expenses, amounting to $6 billion. This resulted in an average renovation cost of $779,000 per store, with the franchisees shouldering about $350,000. The financial burden became more acute for poorly performing or outdated outlets, which saw the renovation costs ballooning to almost $1 million, pushing the franchisee's contribution to nearly $500,000. These expenses threatened the financial viability of 40% of the franchisees, potentially affecting their lease renewals. Unsurprisingly, franchisee satisfaction with McDonald's plummeted, averaging a rating of 1.19 on a scale of 1 to 5 in 2022. The discontent led to the establishment of the National Owners Association in 2018, the first of its kind in McDonald's history. Despite this organization's advocacy, McDonald's remained steadfast in its remodel policy, even introducing a new $70 million technology fee. Although McDonald's prioritizes its shareholders and consumers, it does so at the expense of the franchisees. Given that independent business owners operate 93% of its locations, alienating them might not be a long-term strategic move. Unfortunately, McDonald's seems to have relegated the franchisor-franchisee relationship to a mere facade. The core McDonald's business lies not in its iconic burgers and fries but in real estate. Their business model hinges on owning desirable locations worldwide, leasing them to franchisees for a significant profit. The recent real estate boom has further inflated the corporation's assets, straining the franchisees' finances. The generational shift presents another challenge. The internet era has provided an array of opportunities for potential business owners, with the ability to become partners with technology companies, or pursue well-paying jobs without the stress of running a restaurant. Younger generations are less inclined towards fast food businesses. To add insult to injury, McDonald's appears indifferent to the reasons for franchisee exits, and even impedes the transition process. The corporation has increasingly exercised its right of first refusal, preventing franchisees from handing over their locations to trusted successors. This maneuver allows McDonald's to direct the stores towards more passive investors, exacerbating the existing franchisees' frustration. Unless McDonald's initiates swift and decisive action, the escalating franchisee exodus might significantly impact its business model. A disgruntled franchisee could potentially affect the customer experience, making the store unprofitable and unable to pay the lease, which forms the crux of McDonald's income. With 28% of stores already sold off or closed in recent years, the corporation faces a real and immediate threat. The Golden Arches must prioritize mending its relationship with franchisees, or risk a rapid, unwelcome unraveling of its empire.